All right, awesome. So let's go ahead and get started. So, welcome. I really appreciate you joining. I know you could be absolutely anywhere today, but you decide to be here with me. So I'm really thankful for that. And I know you're here because you have a lot of questions about passively investing in multifamily real estate. And so, one of the things that I love to do is I love to teach about this topic. It's a topic that people have heard about, but they don't really know what it is. They're not fully understanding what multifamily is and what exactly passively means. So this webinar today is going to be all about passively investing. We're going to walk through a lot of details. There's going to be a lot of information. If you have a notepad, get it ready because we're going to cover a lot. All right, so without further ado, let me go ahead and just get started. I want to start by first sharing a little bit about me. So, again, my name is Tanya Weathers. I'm actually from Avon Park, Florida, by way of Tampa, Florida. I currently live in Dallas, Texas. I am a senior instructional designer and I specialize in e learning development and training programs. I've been doing for that for about 15 years. And I really enjoy it. I have an associate's in computer engineering, a bachelor's in magazine journalism, and a master's in adult education. I've actually been investing in real estate since about 2014. I started with Airbnb short term rentals. I soon went into house flipping and house hacking and now multifamily. And right now I'm focused almost full time on multifamily. I'm actually a current student of the Jake and Gino mentorship and a former student of Think Multifamily. They're really popular national mentorships revolving around multifamily. I love to travel and experience different cultures. And then I'm really passionate about breaking generational curses through self healing and financial wealth. Those are the two things that I'm really passionate about. So that's just a little bit about me. So let's go ahead and get started. So, the topics, I'm going to cover 5 things today. So, the main one will be about your why statement. Well, not necessarily the main one, but one of the topics we'll talk about is your why statement and your financial goal. That is probably the biggest thing that I talk to people about before they even think about getting into real estate, because your why statement and your financial goals will help you align your strategy with exactly where you want to invest when it comes to real estate. Then we'll talk about exactly what multifamily is, why multifamily is the best investment, how do you invest in multifamily, and then where to start as a passive investor. So those are the 5 topics we'll cover. I'm happy for you to jump in and ask questions. Feel free to use the chat as well, or you can unmute yourself and ask questions as I go along. We have a lot to cover, but if you need to interrupt me for me to clarify anything, please do. All right. So, what is your why statement? So, when it comes to your why statement, I think knowing your why statement really helps you to understand your purpose. It gives you drive and it really motivates you to move towards your ultimate goals. A lot of times people will say, oh, I just want to get into real estate because I want to make money. I hear a lot of people make money and I want to build wealth. Okay, yes, we all know it's about the money, but what is it that you're trying to accomplish with that money? I think it's really important to dive a little bit deeper because investing in real estate, I'll be honest, it is not easy. It takes a lot of education, it takes time, it takes strategy. And if you don't have a why behind what you're doing, you are likely to just quit and say, you know what, this isn't for me. So I really do believe having a why statement behind what you're doing is really important. And I always like sharing my why statement. So here's my why statement. I want to have unlimited options so I can live in all the abundance that the world has to offer. I no longer want to worry about time, money, energy, or my ability to give to others. That is the why statement that I live with on a day to day basis. I love to travel. I love to eat. I love to experience new things. I like being outdoors. And when I'm tied to a job, it's a 9 to 5 that I'm just working paycheck to paycheck, I don't have the option to live unlimited. I don't have the option to live in abundance. I don't have all the time. I don't always have the energy. And so those are the things that I keep in the back of my mind when I'm driving forward and creating strategy to build wealth. So I really encourage you to do the same. Yours might be different. It might be surrounded around your family, your kids. Maybe it's even around your parents. You want to be able to provide for them when they get into their older years. Whatever your why is, I think you really need to think about that to drive things home for you. The next thing is setting your financial goals. So again, real estate does take money. And if you don't understand what it is that you're doing with that money, you can get lost and you can have a hard time figuring out exactly where you want to put your money. So I actually recommend that you do something called create SMART goals. You may have heard of this, may not. But SMART goals is a way to define goals as specific, measurable, achievable, realistic, and timely. And it allows you to get a little bit more focused with your goals. So here's some examples, right? So when we say specific, it means, what do you want to do? So as an example, we'll say, I want to save $15,000 a year so I can travel 3 months out of the year. Okay, how is that measurable? How will you know when you've reached that goal? Well, I'll review my finances every month to measure how much I've generated. And the goal in this case, let's say it's 1,250 a month, right? That is the goal. So you know that if you're making 1,250 a month, then you are on track to reaching that 15,000 a year. So how do we make it achievable? Is it in your power to accomplish it? So in this example, yes, I'm currently generating 500 a month in extra income and learning how to invest in real estate to generate more. So you know it's achievable because you're putting the correct steps in place. Realistic. Can you realistically achieve it? Yes, this is realistic because my real estate strategy can generate at least $2,000 a month. And then timely, what exactly do you want to accomplish in that time frame? Or what time frame? 6 months, right? So I think having some sort of SMART goal to align with your own personal financial goals is really going to help you determine which strategy. Because I'll tell you, when I first started off with real estate, I had this number in my head and I was like, I want to make $5,000 a month in Airbnbs. Well, I didn't realize that it's going to take me probably about 10 Airbnbs just to do that. And then I had to figure out, okay, is that measurable? Can I realistically do that? Do I have the time and energy to do that? Do I have the money to do that? And so it made me kind of rethink what my strategy was based on my financial goals. All right, so here are some questions that I think you should ask yourself when you're thinking about your financial goals. So one, what is your financial goal? We just talked about that. How does that break down yearly, monthly, weekly? So in the example we had before, say $15,000 a year. All right, what does that break down to on a monthly basis? $1,250 a month. What does that break down to a weekly basis? Roughly about $312 a month. Is that realistic, right? Does that make sense for you to be able to do with whatever real estate goal that you have? Then I really suggest you have a personal budget plan. And the personal budget plan that I follow is actually the 50-30-20 plan. It's where you take 50% of your income and you put towards your fixed expenses, that being your house, your car, your insurance, things that do not change and are necessities for you to live. 30% of your income goes towards flexible, meaning anything that is not consistent on a monthly basis, anything that you don't need, like that Netflix subscription or the gym subscription or the massages, whatever it is, that's the 30% flexible. That's your play money. And then 20% savings. So 20% of your income automatically goes to savings. Now, I have this plan, I have it taken directly out of my paycheck. That 20% I barely even see. And that 50 and 30 I allocate appropriately depending on my fixed or expense, my fixed or flexible. And the reason that I really harp on having a personal budget plan is because The question of how much money do I need to save in order to invest? Or the question of, well, I have money, I have about $20,000 to save. Can I start investing? And my question is, well, how does your budget look? Because if you have $20,000 that you've saved, but you're not budgeting your money right, let's say you go overboard and spend extra in the month in places you shouldn't have. Now do you have to tap into that savings? Like, what does that look like for you? So do you have a budget plan? Are you following that budget plan? Another thing is, how is your credit? Credit does play a big part when it comes to some real estate strategies, not all, but some. And then how much do you have in your savings and how much do you have to invest in real estate? So those are probably the biggest things that I would really want you to ask yourself when you're thinking about, before you think about investing in real estate. I do have a worksheet that kind of helps you break that down. After this webinar, I'll make sure that I give that to you and you have access to it and you can use it to decide your financial goals. And then a couple more things. So I have a few tips when it comes to your personal goals. One, keep your personal savings separate from your investment savings. That is a big one. Again, I get people say, oh, Tanya, I have $20,000 to invest that I've been saving up. Where can I put my money? And my question is, wait a minute, is that for your personal savings or is that for your investment savings? Again, I believe personal savings should be for rainy days, an unexpected bill, perhaps you get into an accident, perhaps you need to help out a family member. Do you have money to do that, or are you dipping into your investment savings, right? So always keep your personal savings separate from your investment savings. Tip number two, always work on your credit. I've been working on my credit, I don't know, 10, 15 years I've been working on my credit, and I always think that it can get better. Unless you're at an 850, I think you can always work on your credit. And all it's going to do is put you in a better position when you start investing in real estate. And then tip three, adjust your budget plan as needed. It doesn't have to be something that you always stick to. I didn't always start off with the 50-30-20 plan. Those numbers have wavered over the years, but whatever it is, you can feel free to adjust the plan. Just make sure that you have a plan. All right. So before I continue, let me know if you have any questions. John, do you have anything, any comments, any questions based on what I've said so far? And your silence is fine. I know you're multitasking too. All right.
Hear me?
Yep, I can hear you.
Okay, cool.
All right, no question. Good, no question. All right, so next thing, what is multifamily real estate? Right? I think a lot of people misunderstand the word multifamily when they hear it. So I really want to make sure that I give you the correct meaning of what multifamily is. So when we're talking about multifamily, we're talking about any property containing more than one housing unit. So think of duplex, townhome, apartment. Those are considered multifamily. When it's anywhere between 2 to 4 units, it's actually considered residential. So, and that's mainly for tax purposes, that's for loan purposes. Anywhere between two and 4 units, you can typically get a residential loan, just like a regular single family loan. Anything that's 5 plus is considered commercial, and there's different qualifications for commercial. There's different loan options for commercials, and there's different qualifications, different regulations when it comes to commercial. So just want to make sure that you understand the difference between those. Also, when it comes to multifamily, especially on the 5 plus unit, they're always categorized by classes, class A, B, C, and D. So what do I mean by classes? So class A is usually going to be something that was built within the last 10 years. It's really fancy. It's probably located in the best of neighborhoods. It has a phenomenal walkability score. It has really high amenities. It has like a class A pool and gym and It may have stainless steel appliances and hardwood floors. It looks nice, and it's probably going to have the highest rents in the area. So that's class A. Class B is anything that's built within the last 20 years. Now, it's still well located. It might still be in a nice area, but it might have a little dated finishes, right? It might not have all stainless steel. There might be some black appliances in there instead of stainless steel, or there might be some vinyl flooring or different types of older dated tiles that are throughout the apartment rather than the nice finishes. The common areas aren't as nice as a class A, right? It might have a pool, but it not might not be like an Olympic style pool, right? And then it also might have deferred maintenance, which means that it still might need some maintenance here and there. It's not awful, but it still has some maintenance that still needs to be done. And it has moderate rents. It's not the highest, it's not the lowest, but it's a moderate rent for Class B. Class C Class C apartments is usually built within the last 30 years, and they tend to have smaller units and smaller floor plans. They also are dated. Typically, they don't have any communal amenities, so typically they don't have a pool at all. They don't have a gym. They don't have anything like a pet area or anything like that. They normally have no communal amenities. They often have a lot of maintenance. Maybe you see in the picture here, they may have outdated siding. The roof might not be up to date. And then the rents are going to be lower in the market. Class D properties is usually over 30 years old. It has high vacancy. If you've ever been in a Class D neighborhood and you've seen apartments that may have boarded up windows, and it has high crime in the area, it's most likely a Class D project, a Class D property. And usually there's a lot of neglect of the property in general, and it's probably going to have the lowest rents in the market. So it's really important to understand these different classes because when it comes to real estate strategy, some investors only invest in specific class types. Me, for example, I only invest in class B and class C. Ideally, it would be a class C property in a class B area. So it might be a coming up area or an area where you've seen a lot of development happening. There's a lot of change in the homes. They're starting to get renovated. But this C property, it just hasn't been touched yet, but it's in a good area. And the reason that I personally like to invest in those is because they have value add that's associated with them. So you can go in and put that new siding in, put that new roof, put some new updated finishes in the kitchens and the bath and the floor. Maybe you can put in a little pet park, right? So you can do different things to a Class C property and build it up to a Class B property. So that is all about what multifamily real estate is. And again, I just want to pause just for a second to see if you have any questions. Again, your silence is also okay. All right, let's keep going. So why multifamily real estate is the best investment. So these are the top reasons why a lot of people are investing in multifamily real estate, especially now. We have potential for cash flow, diversification, inflation hedge, tax benefits, and potential for appreciation. So when we talk about potential for cash flow, basically, you're collecting rents from these units, right? Let's say it's a 50 unit apartment complex. You're collecting rents. So that is passive income, right? That is cash flow that's coming through your books every single month. So potential cash flow is a really big reason why people invest. It's passive. You can sit on a beach and still be collecting money while doing absolutely nothing. Now, the reason it says potential cash flows because not every real estate deal cash flows, especially not in every market and not in every market cycle. Here in Dallas, there has been a little slowdown of cash flow lately, only because the Dallas market is slowly starting to change. It's slowly starting to get to the highest, and it might end up turning over and kind of dipping a little bit towards a recession. We have no idea how big the hit will be, how big the recession will be. But when you have that happening, when rates are really high and you're about to dip to a recession, cash flow tends to be a little less in a market like that. But there are other markets. Let's say I was just talking to someone who's investing in Memphis. Memphis has a really great market that has really strong cash flow. So that's why potential is always there in front of cash flow. It really depends on your market and the cycle that that particular market is in. The second reason is diversification. Multifamily real estate can provide diversification benefits to an investment portfolio. It's an asset that tends to have a low correlation with stocks and bonds. And that's a thing that I love about it. So you might hear, I don't know if you're someone who likes to watch MSNBC and understand what the stocks and the bonds are doing in the market on a day-to-day or hourly by hourly basis, right? But you'll notice that stocks can go up and down during out the day, during out the week, during out the months, during out the year, right? But the rent is going to stay the same. Right now, I'm living in an apartment. And when I signed my lease, I signed it for an exact amount per month for 12 months. It doesn't matter what the stock does, up and down, my rent is going to stay the same. So it has a very low correlation with what the stocks are doing. Now, after that year, if the stocks plummet, yeah, my rent might increase, but that would be a year later. Right. And so you would want to make sure that when you're investing, that you're understanding what your strategy is and what your asset will do, even in hard times. And that takes us to number three about hedging against inflation. So real estate is often considered an inflation hedge because rental income and property values tend to rise with inflation. So even though inflation is rising slowly, rent income also tends to rise, and it's a great place for you to be able to put your money and save that money and grow even during inflation, because during inflation rents go up, and that's not so great for me as a tenant, but that's great for me as an investor. So it's a great place for me to park my money and being able to create that that passive income as the flow of money comes in. Number four are the tax benefits. So there's so many tax benefits associated with real estate. I can't even name them all, but there's a lot of depreciation deductions. There's passive activity losses, capital gains, tax deferrals, and so much more when it comes to investing in real estate. And that doesn't matter what kind of real estate, whether it's multifamily or not, there's always tax benefits associated with real estate. And then the final one is potential for appreciation. So multifamily real estate can also provide potential for appreciation over time. So as you're making improvements to a property, let's say you bought it at a nice, reasonable, low price, and you're making improvements and you're holding it for years, 9 times out of 10, it has a potential of appreciation. But notice that word potential in front of it, just like the potential was in front of the cash flow. It really does depend on the market, and it really does depend on the market cycle. So again, that's a great reason for you to think back again, what is my financial goal? Do I have the time to hold a property for years for the potential appreciation? Or do I want to invest in something right now that's going to give me immediate cash flow? So, depending on your strategy, will determine what kind of real estate and what kind of multifamily deal that you get yourself into. All right. So, now that we've talked about why multifamily real estate is the best, and here's a recap again of the 5 reasons, right? Cash flow, diversification, inflation hedge, tax benefits, and potential for appreciation. Now let's talk about the nitty gritty, how to invest in real estate and multifamily real estate. So I want to explain this topic by talking about the differences between single family and multifamily. Okay, I think sometimes that's the best way because single family, most of us know about the process of buying single family. So let's talk about when you're buying single family. And this is purely for educational purposes. This is not all related to buying single family, multifamily. It's just the basics, right? So let's say you were going to go and buy a single family home. There's some qualifications that you're going to have to meet, right? They're going to look at your credit score and different credit events, such as bankruptcy. They're going to look at your income, what you're bringing in for your W-2 or your 1099. They're going to look at your expenses, and they're going to look at your debt to income ratio, right? And based on those numbers, they're going to tell you how much you can afford. So based off of that, let's say, okay, you can afford a $500,000 home. And so the lender gives you authority to go out and find a $500,000 home. Once you find it, then you work on securing that loan. You put a down payment in, you do the closing and title costs, find a good insurance company, and you got your home, right? Now, of course, there's some more stuff in there, but those are the basics, right? With multifamily, it's actually similar, but a little bit different. So the qualifications are different when it comes from single family, multifamily. One, because look at the top there where it says purchased by one or two people for the single family home. And then on the multifamily side, you notice that it says purchased by a group of people or entities, which are the general partners or the limited partners. Now, I remember before I got into multifamily, I would drive by buildings or I'd be living in an apartment and I'd wonder, that man who owns that place must have a lot of money for him to be able to buy that apartment building. It's a gorgeous apartment building or it's a huge apartment building, right? And I would always say that or ask, I'm like, who owns that? Now that I understand a little bit more about multifamily, I now understand that it's not going to be just one person. 9 times out of 10, it's a group of people or a group of entities that own that multifamily apartment. And those people are called general partners and limited partners. So keep that in mind. We're going to go into more detail a little bit later about the difference between general partners and limited partners. But keep that in mind that apartment buildings aren't just owned by one person, they're owned by multiple people or entities. And so when it comes to the qualifications for multifamily, the qualifications and the securing of the loan involves the entire group. It's not just one person or each person, right? It's the group as a whole. So they look at things like the net worth, the liquidity, the credit scores and events, the borrowing entity, the experience, and the deal. Again, those aren't all the things that they look at, but those are the majority of the things that they look at for you to be able to qualify to get into a multifamily deal. And so, just for example, when it comes to the experience, you may not have any experience when it comes to multifamily. I know when I first got into it, I didn't have anything. I was still learning when it came to the experience. So I didn't have any. But the people in the group that I was investing with, they had the experience. And not even all of them. It was only one person that had the experience. But that's all that the lender needed to see, is that there is somebody in this group that has the experience and they've been there and they've done that. Right. Another thing with the deal, and I put that in capital letters because that's really different from a single family home. A single family home is not producing income from the home, right? Unless your single family home is an investment and maybe you have an Airbnb or something like that. But even then, the lender is not going to look to see, I wonder how much they're going to get for their Airbnb. They're not looking at that. For multifamily, they are. They want to know, what do you expect to get from rents? What are the expenses going to be? Who's going to be the team that's going to be working this deal? They want to know the net worth of the people that are going to be involved. They want to know everything. They want to know about the returns at the end of the day. Is this going to be a bust or not? Right? That's what they really wanting to know when it comes to the qualifications outside of the net worth and the credit score. And then when it comes to securing the loan, there's similarities, right? You still have to put a down payment down. You still have to put closing costs down. But then there's also something too called reserves. A lot of times to secure a loan, they want to see that you have reserves. And reserves means that it's extra money set aside in case shit goes down, right? In case a fire happened, in case like here in Dallas when there was a big a freeze that water pipes burst. Do you have money for that? Yes, in those cases, insurance may cover it, but it may not cover it all, right? Or if there was something that unexpected happened to the parking garage and one of the gates itself can cost $10,000 just to fix a parking garage gate. Do you have money set aside for that? So those are things that a lender will still look for if you have set aside. And sometimes they don't want to just see it set aside in a checking account. They want you to give it to them and they put it somewhere safe, right? CapEx. CapEx is another thing that they look for to secure a loan. CapEx basically means money to fix big issues from within the next 6 to 12 months. So if you go in and you say that you want to buy a multifamily home and you see that the roof is old and it needs to be replaced, CapEx is going to be used for that. And it's different for reserves because reserves is money put aside for something you don't expect. CapEx is money put aside for something you do expect that you're going to have to fix, and you're putting that in your business plan to actually fix. So those are the biggest difference between single family homes and multifamily homes when it comes to buying. Now, let me take a pause and see if you have any questions about that. And then if not, we'll move on to how you can manage multifamily versus single family. Okay, good, no question. So let's talk about managing single family versus managing multifamily. So when it comes to single family, right, you have a home and you're having to manage it. Most people don't think of their homes as having to be managed, but they do, right? So you have income that's coming in, whether it's from your full-time job or a side hustle, different investments, or whatever else you got your money coming from, that comes in from the income side. Then you have your monthly expenses, right? You have your mortgage, you have your property insurance, taxes, HOA, utilities, maybe you have security system, maybe you have lawn care, pest control, or some other expenses, right? You're having to manage what comes into your house and what goes out of your house to successfully manage it. So you don't go into foreclosure or you don't have to dip into your savings, right? So that's when it comes to managing a single family. Now, believe it or not, managing a multifamily is almost identical. The only thing is that the income and the expenses are a little bit different. So instead of it just being income from your full-time job, the income is actually coming in from the rents, from the application fees, parking fees, pet laundry fees, rubs, right? So those are different things that how a multifamily operator can create income. And to explain RUBS for a moment, RUBS is actually when, let's say you're staying in an apartment complex and they're charging you for water, sewer, trash, right? So you have your regular rent, and then on top of that, you might see an extra $20 charge for those. In actuality, what's happening is that the apartment already paid for those things. They might have a contract with the city for the water or the trash, and they might be paying that already for the entire apartment complex. They're already paying for that. And that $20 that they're charging you is them paying themselves back. And what they call it is rubs. And so that's just another way that they're making income. Now, it does often balance out the expenses if it's being taken out as an expense on the other side, but sometimes it's not, but we still want to include it in as income anyway. And then monthly expenses. Again, they're pretty much the same: mortgage, insurance, taxes, utilities, pest control, right? The only thing that might differ, things like staff, right? You have to have a front office. Well, not all the time. Not every multifamily has an office, right? But you might have an office staff. You might have maintenance that you have to pay. Other things might be, you might have to pay to get the pool cleaned, right? So there are just different things that are included in multifamily as far as expenses. But as you see, managing a single family, managing a multifamily are pretty much the same. It's about figuring out how to make more money, create more income, and reduce your expenses. That is the game. The better you can do that, the more you can reduce your expenses, the more successful and the more cash flow you'll have with multifamily. There are some people within that group that you see above. I said that it's purchased by a group. There are some people within the group that that's all they do, is that they just manage the income expenses on a day-to-day basis to make sure that the property is cash flowing and it's giving the returns that the investors expect. All right, and so the last thing with this topic is the selling. So this one's really simple. When it comes to selling single family, it's pretty easy, right? You call an agent, or you decided that you're going to list it yourself and say, hey, I want to sell my property. They're like, okay, cool. I'm going to go and take some pictures and give you a price and what I think you could sell it for. And then I'm going to put it out there, put it on the MLS, tell other realtors about it, and see if we can get some offers. Right. And if they get an offer, then that buyer is going to have an appraisal done, going to have inspections done. And if everything works out, you sell it. With multifamily, it's a little bit different. And the reason it's different is because multifamily is valued different. A single family home is really based off of comps in the area, right? What are the other houses in the area being sold for? Um, and that's really what it's based on. Sometimes it's based on other things, right? Like the amenities and how nice you fix it up. Yeah, those things matter. But it also really, it is really comparable to those comps. With multifamily, it's not comparable to other comps. I'm not gonna say it's not, it's just not comparable as much. So when it comes to selling it, right, you can still get a real estate agent or real estate broker, or you can still sell it yourself. But the process side is different. So when it comes to underwriting and managing, underwriting is basically managing and figuring out what that income and expenses are doing over time. So you're going to take what's called a T12. A T12 is basically a trailing 12, a T12 of the last month of profit and loss statements. So you're going to see, okay, what was this profit for the last 12 months? What were the losses over the past 12 months? What were the rents over the last 12 months? What were the late fees? What were the mortgage payments? What was all of this stuff? And we're going to put it into an underwriting spreadsheet so we can see, is this a good deal or not? Are we going to be able to project over a few years? All right, if we raise the rents, if we decrease the expenses, if we increase the income in some kind of way, will we meet a good return in 5 years, in 7 years, right? That's what the underwriting process is. There's also extensive due diligence. So on the single family side, there was a talk about appraisal and inspections, right? Well, with due diligence, it's a lot more than appraisal and inspections. A lot of times with single family, they might look at the roof, they might look at the foundation, right? They'll look at the plumbing, electric, things like that. But you're talking about large buildings, so they have to do extensive due diligence and look a little bit deeper. In some cases, they might even do environmental studies to see how toxic is the ground, right? So those are just different things that are involved in when somebody goes to sell the property and buying as well. It's kind of on both sides. They also have to do market research. Is there job growth in the area? Is it in a path of progress? Path of progress means basically, is there new development happening? Is there new money in the city being put in this area where you're buying? Also want to know, are there good demographics in that area? So there's different market research that needs to be done. And then exit strategy, right? So what are they going to do with this? Are they going to just hold it for a year or two and they're going to quickly fix it up and quickly sell it? Or are they going to hold it for five years or hold it for 10 years? What is the process that they're going to do upon exit? So all of those things are included in selling. And it's an extensive process. I'm not going to lie. Buying, managing, and selling multifamily real estate, it does take a lot of education and it takes a lot of understanding of what this process is. And so, one of the things that I always say is that you need to be mindful. Be very mindful because it's extremely important to understand the ins and outs and to educate yourself so you can avoid pitfalls and prevent yourself from losing a lot of money. So that's why I really enjoy teaching these sessions because there's a lot of information out there, but a lot of times it can get muddled, right? And so you want to make sure that you're educating yourself, you're doing your own due diligence, you're doing your own research about the topic so you don't get got. Just say it like that. All right. So before we go on to the roles and responsibilities of general partners and limited partners, I'm just going to pause again to see if you have any questions whatsoever. And again, I do have a Q&A session planned for the end, so you can always ask questions too. All right. Roles and responsibilities of limited partners. So as a limited partner, and that's really what we're talking about today, right? Because there are two different types of partners. There is a general partner and there's a limited partner. And so the difference is a general partner are the partners that do it all. They're considered active. They're also referred to as syndicators or sponsors. So those might be thrown around: general partners, GPs, syndicators, sponsors. Those are all the same thing. They're responsible for the day-to-day operations and all the key decision making. They're the ones that are sourcing and looking for the deal. They're negotiating, underwriting, hiring staff, executing the plan. They're raising the capital and much more. They also have equal liability within the general partners. Now, a lot of time it does depend on how much the general partners are putting into the deal themselves, but most likely they all have equal liability. Passive investors, though, which are also known as silent partners, they're just putting money in. They're just investing their money in exchange for a portion of the profits. And they have limited liability to the extent of their share. So let's say that they're only putting in, let's say they only have about 10% of the share, then they only have 10% of the liability. So those are the big differences between the active and the passive. And what we'll talk about from this point on will be pretty much about the limited partners, because limited partners are the ones that really allow you to have the most time and energy where you don't have to put it all into finding deals and negotiating with lenders. You can just give your money and sit back and collect cash flow. So that's what we'll be talking about. So roles and responsibilities of limited partners. So here are some prereqs that you need to think about before becoming a limited partner. One, you really got to like real estate. I have to say, because a lot of the times these deals, they're long-term deals. So if you're still on the edge about, is real estate really what I want to do? Is real estate really the place that I want to put my money to hedge inflation? If you're having doubts, I wouldn't invest in real estate, because the prereq is like you kind of have to like real estate to invest in it, right? Um, you must want to be a passive investor with limited liability and limited control. And then every sponsor has a different strategy. You need to decide what works for you and find sponsors who align with that. Again, that goes along with what I was saying before about deciding what your financial goals are to determine what your financial strategy is. And so we talked a little bit about the classes, right? Class A, B, C, and D. Those classes, they create different kinds of strategy. For example, Class D, if you're investing in Class D, and usually they're not in the best of neighborhoods, usually they have a lot of crime that surrounded them, or the apartments are pretty decrepit and they need a lot of work. I've seen people take D properties and completely revamp them and spend 6 to 12 months revamping them and remodeling them and pull out millions of dollars. And they do it in 6 to 12 months, right? I've seen that happen. And then I know people that completely stay away from D properties because there is just so unpredictable. You don't know if the crime is going to shift. You don't know if the rents are going to be able to get to the level that you want them to. So depending on your strategy, if you're wanting to flip really quickly, maybe D works for you, maybe C works for you in a short term period. But knowing that will allow you to find the right general partners and sponsors for you. Also, cash flow, force equity, and buy and hold are also strategies that you want to align with when it comes to your sponsor. And then another prereq is you must have some capital to invest. I'll be completely honest with you. The typical investment for limited partners is $50,000. That is the minimum. And that is normally for larger apartments, right? And then that 50 plus multifamily, or excuse me, that 5 plus multifamily that we talked about. I have seen some deals out there where 20,000 or 25,000 is a minimum to get in, but the typical is about 50. Okay. All right, some more prereqs. So you also need to know what type of investor you are. So there are two types of investors, and these definitions are based on the Security Exchange Commission. Whenever you're going into a group together to invest with people, and usually it's under, I mean, there's some conversation about out there about what's the exact number. But I would safely say if you're investing with 5 people or more, you're going to have to follow the SEC regulations. You have to. If you're investing with 5 people or less, that's more like a joint venture, what they call joint venture JV deal. And you don't necessarily have to follow SEC regulations. Now, I'm going to say that I didn't just say that, but that is a soft rule that a lot of people in the investor community kind of live by. So it's about 5 or less. There's some people that have did 8 people in a group and still didn't have to follow SEC, but I digress. But what you need to know is that when you're going to be investing with a large group of people, you have to fall under one of these things: a sophisticated investor or an accredited investor. So what's the difference? A sophisticated investor is usually only able to invest in 506B offerings. And being a sophisticated means that you have some type of financial knowledge and you understand the rewards and risk of financial investment. And that can simply be by you having a 401k or by you having an IRA, right? Or having stocks. The fact that you have stocks means that you know about financial business and that you understand the risk and merits attached to them. That's it. That's the only qualification that you need to be considered a sophisticated investor. Now, sophisticated investors cannot invest in any and all deals, right? And so that's why it's very good to understand which one that you fall under so you know what kind of deals that you can invest in. Accredited investors can invest in 506B and 506C, and they must meet at least one of the SEC regulations when it comes to income, net worth, or other factors. So you would have to meet one or the following: that you either have a net worth exceeding $1 million individually or jointly with your spouse, excluding the value of your primary residence. So that's $1 million net worth, excluding your value of your home. You have to have an annual income exceeding 200,000 as an individual or 300,000 as a joint income together for at least 2 years. You have to be a general partner, an executive officer, or a director for the company issuing the security. You have to have a private business entity that exceeds 5 million in assets, or if all equity owners are accredited. And then lastly, if you hold some type of professional certification, designation, or credentials issued by an accredited educational institution. Now, I know that's a lot, but the great thing is that you do not have to meet all of those requirements. You only have to meet one of them. I'll tell you that I know that I myself am a sophisticated investor because I am aware of financial affairs and financial matters, and I understand the risk and merits of investing simply because I'm doing this every day, and because I have a 401k, and because I have an IRA, and because I have stocks and bonds. I'm considered a sophisticated investor, and I can invest in 506B offerings. I'm also considered an accredited investor because I am a general partner of a company that has an offering, right? So I can actually do both. I'll be honest, I do not have $1 million in net worth. I wish I did. I'm working on it, right? That's why I'm investing in multifamily, but I don't fall under all of these bullet points, and you don't either. And so keep in mind that it is not a holistic thing. You do not have to meet all the requirements. You just have to meet one or the other. Most people that I personally run into qualify for the sophisticated simply because they might have a 401k or an IRA or something like that. Okay, so those were the prereqs. I know those were a lot of prereqs, but those were the prereqs when it comes to understanding what you're getting into and your roles before getting into an investment. So here's what you need to do if you're interested in getting into multifamily. One, you need to find an investor and you need to talk to them. You need to see, not necessarily an investor, a general partner, a sponsor, right? You need to talk to them and see if you like them. See if they're just genuine people. See if they're ethical people. I say that is number one. I've actually invested with some people that I don't really like, and I don't think I'll really invest with them again, just because I don't think that our values aligned, right? What is their background? What's the team like, and what's the roles? How many deals have they done? What markets do they invest in? How do they communicate with their investors? Do they communicate monthly, quarterly? What percentage of their own money have they invested? And then always ask for references of previous and current investors. So these are just a few things that you need to think about when you're looking for a sponsor to work with and you're looking for investors. When it comes to the SEC regulations, a lot of them are going to require that you have a substantive relationship with that sponsor, meaning that you've talked to them on the phone, you've been educated with them, maybe you've had coffee with them, right? And that needs to be noted somewhere. So those are things that you really want to do, is to get to know your sponsor. Another thing is analyze the market that they're offering, right? And so if you find a sponsor and they're like, hey, we have this great deal, Would you like to invest $50,000? Like, wait a minute, hold on, let me do some homework. And the homework that you need to do is you need to see if it has great population growth, job growth, income growth, how is the house value growth, and is the crime rate declining? We talked about that a little bit earlier. So you want to make sure that you're investing in the right place. Like everyone wants to come to Dallas and invest. Every person that I meet wants to come to Dallas and invest. But they need to know that not all areas in Dallas are good places to invest. And so you need to do that analysis for yourself to really see, oh, okay, they're going to put this place up in Plano. Okay, I think that might be a good spot, right? Or they're going to Frisco. Okay, I think I'm okay with investing there. But you need to understand that market before you decide that you're going to get into that deal. Another thing is you need to analyze the property, right? So understand the business plan. What does the GP plan on doing with this property? Are they going to fix the roof? Are they going to put in new countertops? Are they going to put in new floors? Are they going to fire the staff, right? What are they going to do? You also need to know the story behind the property. I always like to know the story behind the property because it tells a lot about where it's been and where the potential is. So, a lot of times I personally try to look for properties where they're run by what we call mom and pop. So it's, literally a mom and pop running the property. Again, I like to invest in C properties. They're running the property. They haven't really increased rents in like 5 years. They're not really running the office that well. Everything is written on paper. They're not using any kind of software. And they're just trying to get out of it because they're done. They're tired, right? And I love to know the story because that amps me up. Like, oh, okay, this is going to be a good one. They haven't been managing it right. So we're going to get really good returns. So understanding the story behind a property, I think is always a good thing to know as well. And then understanding the underwriting. I think we talked a little bit about that before, right? The income, the expenses. What is the goal to raise the rents? How does it compare to other rents in the area? What kind of debt is going to be used, right? What kind of loan is going to be used? Are we refinancing this after a few years? If so, what then, right? Do we get our money back? So those are the questions that you want to ask when you're analyzing different properties. Number four is you want to understand the structure of a deal. So this is where the money is, right? This is where your returns are. And I won't get too deep into this, but I'll tell you that understanding what we call the structure or the split is really, really important when you're looking at multifamily deals. One of the biggest examples of different splits is an LPGP split. For example, the percentage of equity is split between the LPs and the GPs. As an example here, we have a 70-30 split, right? A 70-30 split where the passive investors own 70% and the active investors, the GPs, own 30%, right? So that's an example of a LPGP split. There's also preferred returns, class A and B investors, waterfall. Those are just different things that you want to consider. I have a resource guide on exactly what these are and the breakdown of them. So I'm definitely going to make sure that you have that so you understand splits. And then also a part of that are the metrics, the key numbers you want to look at. So if somebody comes to you and say, I have a deal, these are the numbers you want to ask for first. What's the IRR? What's the cash on cash return? What's the average annual return? What's the equity multiple? You need to know those because that's what's going to determine what the deal is. There's some people that come to me and say, I will not do a cash on cash that's any lower than 12%, right? Or I'll do an IRR that's no lower than 100%. And those are specifics, and you need to know what your specifics are because, again, that's going to align with your financial plan. And then finally, when it comes to roles and responsibility, it's the legal documents. So there are really important legal documents that you need to consider, right, before you become a limited partner. You have the subscription agreement, which basically certifies that you qualify to invest. There's an operating agreement that lays out all the duties and responsibilities of everybody, that lays out all the profits and the splits and when you're going to get your money and when you're going to be able to vote and make decisions, right? That's the operating agreement. And then the PPM, the private placement memorandum, that's basically going to be a project plan, right? It's going to be a document to say exactly what you guys are going to plan on, what they're going to plan on doing with the property, how they're going to operate it and manage it, how they're going to manage risk, what are the projected distributions, right? So those are the main documents that you'll probably be asked to sign before you start investing in a multifamily. And I always say, always get a lawyer. Get a lawyer, have them look at it, never sign anything, especially multifamily, without somebody taking a look at it. All right. So I covered a lot. I covered a lot. And so what I want to what I want you to ask yourself is, can you now answer these questions? You know, what is your why statement and your financial goal? What is multifamily real estate? Why is it the best investment? How do you invest in multifamily and where to start as a passive investor? I really hope that you can answer those questions. And I hope I did a good job of explaining them. It's a lot of information, but I can tell you I didn't learn this stuff overnight, and you won't either. But I think it's really great that you at least started the journey by coming in and joining us.